Wall Street wants you trapped in a 50-year mortgage, convincing you a house is your ultimate investment. But while you're paying for a new roof, the S&P 500 just shattered 7,100. Here is the exact math they're hiding, the great middle class lie. For decades, you've been fed a massive financial lie. Your parents, your uncle at Thanksgiving, and every real estate agent on the internet will look you dead in the eye and repeat the exact same script. Renting is just throwing money away. They tell you that buying a house is the ultimate cheat code to wealth. But what if I told you that for 90% of people, buying a single-family home to live in is actually a financial liability disguised as an asset? Right now, we are in the middle of a massive economic shift. It's April 2026. The S&P 500 recently broke past the 7,121 mark, hitting absolute record highs despite widespread market caution. Meanwhile, the housing market is so brutally expensive that Wall Street is literally floating the idea of 50-year mortgages just to keep monthly payments from suffocating the middle class. Think about what that actually means. You are paying hundreds of thousands of dollars in extra interest, effectively renting from the bank for the rest of your life. You are standing at a financial crossroads. Do you put your hard-earned cash into the stock market, or do you lock it inside a drywall and concrete? By the end of this video, we are going to look at the undeniable, brutal math of stocks versus real estate. No emotions. No American dream fluff. Just the raw numbers. And later, I'm going to show you why a specific highly popular ETF strategy that everyone is talking about right now is actually a massive trap designed to bleed your portfolio dry. You do not want to fall for it. But first, let's talk about the silent money printer. The case for stocks, the effortless wealth machine. Let's get one thing straight. The stock market is the greatest passive wealth creation tool ever built for the average person. Period. When you buy a broad market index fund, like the S&P 500, you are buying tiny slices of the 500 largest, most profitable companies in America. You are letting Apple, Microsoft, and Amazon do the heavy lifting for you. You don't have to wake up at 3 a.m. because a tenant's toilet exploded. You don't have to argue with contractors. You literally do nothing. And the math is staggering. Historically, the stock market returns an average of about 10% per year. Let's say you take $100,000 in cash and invest it in an S&P 500 index fund. You don't touch it. You don't add another penny. In 30 years, assuming that 10% average return, that $100,000 compounds into over $1.7 million. But let's look at the reality of 2026. Inflation is stubbornly hovering closer to 3%. Everything costs more. If your money isn't growing fast enough to beat that invisible tax, you are actively becoming poorer every single second. Stocks offer ultimate liquidity. If you need your money tomorrow, you can click a button on your phone, sell your shares, and have the cash in your checking account in seconds. Try doing that with a house. But here is where the stock market catches people sleeping. It is incredibly volatile. In early 2026, we saw massive, wild swings based on artificial intelligence apprehensions, complex geopolitical tensions in the Middle East, and an energy market that spiked out of nowhere. If you panic sell when the market drops 10%, you lose. The stock market rewards extreme patience and brutally punishes emotion. The case for real estate, the leverage cheat code. So if stocks are so great and effortless, why are there so many millionaire real estate investors? Why does every rich person own property? One word, leverage. Real estate is the only asset class on planet Earth where a bank will gladly hand a normal person a massive bag of cash to buy an investment. If you want to buy $500,000 worth of stocks, you need $500,000 in cash. But if you want to buy a $500,000 house, you only need to put down 20%, which is $100,000. The bank covers the remaining $400,000. But here is the magic trick. You get to keep 100% of the profit on the total $500,000 asset. Let's run the math on this leverage. Imagine your $500,000 house appreciates by a modest 4% in 1 year. That is a $20,000 increase in equity. But remember, you only invested $100,000 of your own money. A $20,000 return on a $100,000 cash investment isn't 4%. It's a 20% cash-on-cash return. You just destroyed the stock market's historical average using the bank's money. And that's not even mentioning the tax benefits. The U.S. tax code is essentially a love letter to real estate investors. Between mortgage interest deductions, 1031 exchanges, and a beautiful little loophole called depreciation, where the IRS lets you write off the value of the building over time, you can legally shelter massive amounts of your income from taxes. But before you run out and sign a 30-year, or God forbid, a 50-year mortgage, you need to hear about the phantom costs. Because this is where the renting is throwing money away argument completely falls apart. The phantom costs, bleeding out in the suburbs. Real estate agents love to show you the appreciation graph. What they intentionally fail to show you is the cash bleed. Let's say you buy that $500,000 house. You think, great, my mortgage is roughly the same as my rent, so I'm building equity. Wrong. Your rent is the maximum you will pay every month. Your mortgage is the minimum you will pay every month. When you own a house, you are hit with phantom costs that silently eat away at your wealth. 1. Property taxes. In some states, these are astronomical, and they go up as your home value goes up. You never actually stop paying for your land. 2. Homeowners insurance. Thanks to extreme weather patterns over the last few years, insurance premiums have absolutely exploded by 2026. 3. Maintenance. The old rule of thumb was 1% of the home's value per year. In the 2026 economy, with heavily inflated material and labor costs, you're lucky if it's only 1.5%. That's $7,500 a year just to keep the roof from leaking and the HVAC running. 4. Closing costs. When you finally go to sell your house to cash in on that appreciation, you're going to lose roughly 6% to 8% of the total sale price to agent commissions and transaction fees. When you factor in property taxes, insurance, maintenance, and the massive amount of interest paid to the bank, that 4% annual appreciation is often entirely wiped out. You didn't make a profit. You just created a forced savings account with a terrible interest rate. The ultimate head-to-head math. All right, let's put them in the ring together. 10 years. S&P 500 versus real estate. Player 1, the stock market. You take $100,000 cash and put it in an S&P 500 index fund. You let it sit for 10 years at a 10% annual return. Result, in 10 years, your $100,000 becomes roughly $259,000, sex net profit. $159,000, zero effort, zero time spent, zero toilets fixed. Player 2, real estate rental property. You take that same $100,000 and use it as a 20% down payment on a $500,000 investment property. Let's say the property appreciates at a historical 4% a year. In 10 years, the house is worth roughly $740,000. You've made $240,000 in pure equity from appreciation alone. Plus, your tenants have been paying down your mortgage every single month. By year 10, they've paid off roughly $65,000 of the loan principal. Gross wealth creation, over $300,000. Looks like real estate crushes stocks, right? Wait, we have to subtract those phantom costs we just talked about. Over 10 years, you easily paid $60,000 in property taxes, $15,000 in insurance, and $50,000 in maintenance. If you decide to sell the property to access that cash, you lose another $45,000 to closing costs and realtor fees. Suddenly, your $300,000 gain shrinks down to about $130,000 in net profit. Stocks beat real estate. It depends. If you successfully manage the property, keep it fully rented, aggressively raise the rent to match inflation, and utilize the tax deductions perfectly, real estate can edge out stocks. But it is a part-time job. Stocks are purely passive. The ETF trap you must avoid. Earlier, I told you I would expose a massive trap waiting for you in the stock market. Right now, in 2026, everyone is obsessed with chasing rapid returns to beat the cost of living. Because of this, Wall Street has unleashed a flood of new hyper-niche ETFs, leveraged AI-focused funds, thematic energy ETFs, and active crypto equity blends that promise to double your money in a year. Here is the trap. Wall Street creates these exotic ETFs specifically to farm high expense ratios from retail investors like you. When you buy a standard S&P 500 index fund, the fee-to-expense ratio is practically zero, around 0.03%. But these trendy, actively managed ETFs charge 0.75% or even over 1%. That sounds tiny, but over 30 years, a 1% fee will cannibalize almost 30% of your total lifetime returns. If you have $500,000 invested, a 1% fee means you are paying them $5,000 every single year just for the privilege of holding the asset. They are selling you a lottery ticket and keeping the guaranteed commission. Don't fall for it. Stick to broad, low-cost index funds. So, which one will make you more money? If you are lazy, and I mean that in the absolute best way possible, stocks will make you richer. If you want to spend your time building a career, traveling, or hanging out with your family, the S&P 500 is an undefeated, heavily fortified wealth machine. You trade cash for freedom. But if you are willing to hustle, if you view investing as a business, and if you want to use the bank's money to multiply your net worth while shielding from the IRS, real estate is the greatest legal cheat code in existence. The only wrong choice is doing neither, holding cash in 2026, while inflation eats roughly 3% of it every year and the S&P prints new records, is the only guaranteed way to lose. Pick your machine, put your money in it, and let time do the heavy lifting.